everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today we're going to talk about the fact that as we are approaching into the middle of the summer here, temperatures continue to increase, yet inflation and CPI numbers continue to cool off, and so that has certainly been the big story, certainly for the past couple of weeks for the market. When CPI numbers came in last week, again, they came in better than expected. This really allowed the stock market to continue the rally that we've really been experiencing for the last couple of months. And so, as you know, inflation's been really a sticky situation in terms of the Federal Reserve needing to aggressively raise interest rates to try to get a hold of this inflation that's really been running unchecked since last year. And so just a chart that I saw today just to kind of show where we are from a year-over-year perspective. And so right now, so in 2021, our CPI numbers are running at about 4%. Right now, we're at about 4.8%. So you can see we really kind of peaked right at the beginning of 2022, and then we've been kind of steadily beginning to finally come down. One thing that's interesting and important to note, though, is the fact that housing numbers continue to be a very sticky inflation point. We've seen some adjustment in terms of food prices begin to come down slightly, but again, there's a lot of other factors going into those food and those housing prices, and so they've been really stubborn to come down. Some other areas, though, that we've seen kind of across the board that inflation numbers appear to be improving. And so again, most investors are pricing in the fact that when the Federal Reserve meets July 25th, they're going to come out and they're going to say, okay, we're going to need to do one more rate hike, and then we'll likely be able to pause. And so that is what markets are pricing in right now. That's the perfection that markets are looking for, that we're only going to need one more rate hike and then we can pause. And then, I mean, investors are even thinking that they're going to start hearing the words that we're going to be able to start backing off some of those interest rates. Now, I don't know if that's realistic or not, but that is what investors who are being polled are kind of saying right now. So just something I thought interesting to keep note of and to pay attention to, because as you can see, if we look back for our year-to-date numbers, so this is the S&P 500, we've really just been kind of on a runaway train, especially looking back from May on. And so when you look at our 50-day and our 200-day moving averages, we have extreme deviations happening right now in terms of where our valuations are and where our means are. Now, you remember 2 summers ago, if you were tuning in with us, we would talk about the fact that you can only stretch a rubber band so far one direction before eventually it snaps back the other direction. So we're approaching that type of velocity right now when you look at how overstretched we are from our means. Moving averages are just that, they're averages. So we know that we can run deviated from them from periods of time, but eventually they come back to the mean. And so you can see for much of the year, we were really trending very close, particularly to our 50-day moving averages. And then once we kind of hit June, things just kind of took off. And so something's going to have to happen to bring these numbers closer in line. Either these averages are going to have to catch up, or our prices are going to have to kind of come down and meet in the middle. And so right now, I mentioned investors kind of have perfection priced into the market right now. They're assuming that there's going to be no more surprises with inflation. They're assuming that the Federal Reserve is going to respond exactly how they're expecting, with no additional rate hikes after July. And so I think that this is a time for investors to at least exhibit some caution. At this point especially, we're at an RSI of 74%. So you know, my magic threshold is 70. When we hit 70 of an RSI, right away, I know that it's likely that we are going to see some sort of a pullback in the short term. So I would not be surprised from where we are here to see some 3 to 5% correction. Typically in the summer, we see some kind of weaker movements in markets anyways. And so a 3 to 5% pullback would not be at all abnormal at this point. Actually, I think that would bring us into a more healthy position. For us to kind of come all the way back down to our means would be actually closer to like 10%. Not sure that that's going to happen, but certainly 3 to 5% might be just enough to kind of allow markets to gather themselves and then continue on. There's a lot of chatter by financial economics that we are going to see all-time highs again this summer, and so that's very possible. I'm just not sure how we'll be able to do that running an RSI this high without having that pullback first. Again, markets can run extended for periods of time. We've seen that time and time again. So I'm not saying that tomorrow we're going to see a correction of 5%. I just know that when we look at how extended we are, we look at relative strength, we look at the fact that there's a lot of things being just priced into the market that will need to continue to happen in order for investors to continue to pay extended prices. And so, you know, we take the performance when we can, but it's just important for us to kind of always have that information in the back of our head. So this might be particularly important if you were considering deploying new money. So if you have cash on the sidelines, or you have, for whatever reason, you have cash that's not currently invested, this might be a time when we look at how far and extended we're running that maybe you consider dollar cost averaging in over a period of time where you just kind of deploy a little bit each month for the next couple of months, and then this way, if we do get one of those pullbacks, that could be an opportunity to put some more cash to work. So just kind of things to consider. Again, it's been we've seen this really strong run up. And remember, the last time that we got to 70% on the RSI, we did see that pullback there. And then again, you can see we hit just 70 here and then had that pullback there. So again, not saying that we have to, anything is going to be catastrophic, but just things to kind of keep in mind. So I thought it would be interesting as we're at the midpoint year of the year, just to kind of look and see what have the general areas of the market done so far year to date. And so these are as of July 18th. And so you can see, so the NASDAQ has had a considerable run, even more so than the S&P 500, up 37% year to date. So the NASDAQ, as you may remember, has it's more of a tech-weighted index. It does have crossover from the S&P 500 as well. You'll see a lot of the same companies, but it tends to be more tech-based. S&P 500 up 18.9% year to date. And so that is going to be, you know, our leading industrial companies, Coca-Cola, McDonald's, Nike. And so the Dow Jones Index up 5.8%. And so the Dow Jones tends to be more of a value play. And so it's not surprising to see that we're lagging the S&P and the NASDAQ, because this has certainly been a year that's been focused on growth, particularly after what we had last year, where growth was really hit with significant declines, with interest rates climbing and with inflationary pressures mounting. And so now that we're beginning to see a reversal of that, not surprising to see that growth has kind of overshadowed those value names that are in the Dow Jones. The aggregated bond index up about 2.5%, depending upon which area of bond you're looking at. Is typically you're up between 1 and 2.5%. And then commodities, which last year had really a stellar year, is actually down 7% for the year. So just to kind of show that rotations are all normal part of stock market values, and they're part of the chains that happen. And so it's important just to kind of know that what is working today may not be working next month or next quarter. And that's why, as investors, it's so important to have a set of rules that you're following. And it's important to always know, why do I own the areas that I own? What role are they supposed to be performing in my portfolio? Because you need to be able to fire them if they're no longer performing whatever set role you've given them in your set of rules. So it's why we talk about having investing rules constantly. It's important. So this, I think, is interesting. So we've seen this extreme run up that we've seen in the S&P 500 and in the NASDAQ, and to a lesser extent in the Dow. And so what does that mean in terms of investor sentiment? Well, right now we are at an extreme greed. And so not surprising when we see relative strengths running over 70%. That's another way of saying, when I talk about relative strength, it's another way of saying that an area of the market is likely overvalued. Okay, so that is when we see numbers in the negative, then they may be undervalued. So that may be an area that could be up and coming and that has potential to kind of run once it takes off. Conversely, an area that is overbought is probably going to need to cool off in the short term at least. And so when we look at where investors are, we're at extreme greed. Now, you know, we've talked before about when everybody's at the same side of the boat, you know, eventually the boat's going to tip the other way. And so that's kind of where we are. Everybody right now is really into this stock market rally. Hey, we love to see stock market, we like to see bull market actions, but I get concerned when everybody is on the same side of the boat with greed, because really typically what that means is, again, once we slip up from that perfection that's been priced in, we could see a pretty quick swing to the other side, at least short term. And so when we see these huge swings this way, I get concerned because it wouldn't take that much to kind of swing the pendulum all the way the other way. So right now, investors are very bullish. Everybody's saying that the stock market can only go higher at this point, and that is usually the time that something could potentially kind of slip things up for at least the short term. So I wanted to take some time to just kind of show you, we haven't done this in a couple of weeks, areas of relative strength within the market. International equities has been sitting on the top here now for months, so it surpassed over domestic equities, and so this continues to be an area of strength, particularly in the developed European markets, and so that's just something to make note of. Number two, domestic equities, specifically mid caps. Large cap growth, not surprising, because we talked about how those growth names and mid caps have actually really been in control of domestic equities even last year. So as we were seeing, you know, so much pressure on markets, mid caps were one of the few areas that were holding up better. And then we can look also technology, not surprising when we think about the fact what the NASDAQ is up. I told you the NASDAQ is heavily weighted in those technology stocks. They are very growth oriented typically, so they're really taking advantage of these inflationary numbers being more favorable. Industrial, basic materials, consumer, cyclical. So healthcare has been an interesting area. So healthcare is an area that tends to be a little more defensive, and so it's kind of playing the middle of the field right here. Now financials, that took a huge hit back in March, as you remember, with the collapse of some of the banking institutions that kind of caught the market by surprise. And so financials have really struggled to recover their relative strength since then, and so they kind of still sit here, and real estate from a relative strength standpoint can tend to be weak. Commodities, below domestic equities. Fixed income still at the bottom of the chart here. So when you're looking for kind of areas of trying to deploy cash, just things that you might be wanting to keep in mind. One thing to mention, that if you do want to use fixed income, a lot to stay away from the longer duration bonds, especially when we're in a period of rising interest rates. Typically those shorter range bonds will do better than the longer range, and high yield has been an area of strength within fixed income in and of itself. And so that's just kind of a little snapshot of where we are within the market. And then this is just another chart that I found, just kind of showing areas of potential. So technology, consumer discretionary, consumer services would all be areas that would be considered to be overvalued right now, meaning they've really heated up and they may need to cool off a little bit. So you might not want to deploy new cash to these areas right now. Versus consumer staples, healthcare, and utilities are all considered to be undervalued with still favorable relative strength. So these are areas that have kind of, it's almost like it might be their turn to kind of heat up for a little bit. And then the areas in gray, real estate, transportation, industrials, financials, and materials, they're kind of like a neutral right now. So just thought it was another interesting way to be able to kind of break down the importance of knowing if areas that you're in are overvalued versus undervalued. And again, if you're currently sitting in areas, so if you're currently in areas of the NASDAQ, if you own the QQQ or you own S&P 500. Doesn't mean that you pull out of those areas now just because they're overvalued. It's just important to kind of know what's your short-term, what are your short-term goals, what are your mid and long-term goals, and then kind of act accordingly. And then again, if you're deploying new assets, just things to kind of keep in the back of your mind as you're kind of coming up with your plan and developing your set of rules. And so that's really just what I wanted to get into today. It's really been a lot of the same, just talking about how kind of markets continue on with this bullish emphasis. From a technical standpoint, we are still in a positive trend. And so I think that we just kind of continue to tread carefully, because obviously we don't want to miss performance. And for advisors and for investment managers, there's a lot of pressure right now, because investors want performance, and so they have to be invested. And there's been a couple of portfolio managers that were not fully invested this year for whatever reason, and now they're trying to kind of make up returns because returns are expected. At the same time, we know that there's areas of the market that have been running extremely extended. And so again, just as a reminder, 3 to 5% pullback or a cooling down would not be out of the realms of normality. And so I would actually kind of expect that to allow us for the markets to continue on. I think it's going to be really important for us to kind of get that out of our system if we want to come into the fall, and then coming into November, December, into the Santa Claus rally for the end of the year. Markets are going to need to either find a way, so there's only two ways that relative strength can come down. We'll have to kind of trade sideways for a period of time and burn off some of that excess, or we'll have to see some pullbacks in the short term to kind of bring us closer to those means. So as always, if you have any questions, this is my contact information. We're here to help. We really appreciate just the opportunity to come and to bring these videos to you. If you have questions, just give us a call. We're always open to hearing about topics that you're interested in hearing. So we thank you so much for joining us. I hope you have a great rest of your July, and we'll be back in August. Have a great day.